So, good evening, everyone. Welcome to the class. In the ordinary shares, till now we are talking about ordinary shares. I believe you know the difference between ordinary shares and preference shares. Preference shares are not very common equity issues, which is done by the company. Normally, the companies go with ordinary shares only whenever they need fund, whenever they do public issue, or IPO or FPO right issue. They mainly raise fund through ordinary shares only. Preference shares are redeemable equity instruments, while ordinary shares are irredeemable equity instruments. Whenever we talk about preference share, the word itself telling its meaning. When in the case of preference share, the shareholder get preference whenever the company declare dividend. The shareholder get preference. But in the case of ordinary shares, so there's no consideration of preference. But ordinary shareholders are the true equity holder of the company. They get voting right. Ordinary shares trade on the stock exchange, while the preference share does not trade on the stock exchange. Preference shares, whenever they issued with definite time period, while the ordinary shares are issued for infinite time period. So that is the difference between ordinary share and preference shares. I hope you understand the meaning of this word called redeemable and irredeemable. So this term is very important. So when we talk about ordinary share, when we talk about ordinary shares are basically irredeemable equity instrument. Irredeemable equity instrument basically means whenever they issued in market, they are issued for infinite time period. In accounts, you studied something called going concern concept. So you know that the promoters will change in the future, but the companies will company will remain the same only. So ordinary share will are irredeemable equity instrument. Like right now, Ratan Tata is running the Tata Group. Maybe tomorrow someone else will run Cyrus Mystery or maybe someone else. But Tata Group I will always be there. Either Ratan Tata is there or not. Whenever we talk about preference share, whenever we talk about preference shares, they are mainly redeemable equity instrument. They are mainly redeemable equity instrument. Talks are going on that preferred shares will be traded on the stock exchange, but still preferred shares are not trading on the stock exchange. So all the shares of the company which we see, which are trading on the stock market, they all are on these shares only. On these shares, you get the voting right. Preferred shares, you don't get the voting right. Here, the problem which I see for VTU. So in VTU problem, they are actually asking you irredeemable. They are actually the problem what you see. The problem what the VTU is asking, they are asking the problems based on irredeemable preference share. In case if they are irredeemable preference share, although preference shares are not irredeemable, but VTU ask questions on irredeemable preference share. So remember the price of the share, if they are irredeemable, then the price of the share is equal to that is equal to dividend divided by the cost of equity. That is the formula for the price of the share if they are irredeemable preference share. So you can see the problem. Uh, where is the problem? You can see the third part A. You can see the question number third part A. I cannot highlight that. I hope you can see that. If you can't see that, then I'll take the screenshot. So BTU asked the problem on irredeemable preference shares only. So this is the question. Tell me what is the price of the share? Everyone, what would be the price of the share? Everyone. if you see the price of the share, the price of share formula, what you need to use, that the price of share is equal to annual dividend divide by the annual dividend divide by the cost of equity. So the annual dividend is 5 rupees, cost of equity is 8%. So you can write this is 500 by 8. So 500 with 8 6 are 48, 20, 20 with 2 are 62.5 rupees. This is the price of the share. So all this, when I'm asking you, they are irredeemable preference share. Okay. Any doubt, anyone? Anyone want to ask any question? Okay. So they are asking you the problems or irredeemable preference share. Similarly, one more problem is being asked. One more problem is asked. Like you can see this question, question number 2A. So you can see the next problem. So so this company X is the company X preferred share is currently selling for 44 rupees per share in the market and pays 4.4 rupees annual dividend. If the investor's required rate of return is 12%, what is the value of preferred share for the investor? Should the investor acquire the preferred share or not? This is the question what they ask you. So so what you can do, you can find the intrinsic value, the price. What should be the price of the preferred share? That price, this mathematically, wherever you find the price by using all these formulas and all. So that is basically called the intrinsic value. Intrinsic value, intrinsic price of the share. Better word would be value. Though there's difference between value and price. Okay, I hope you understand. So you all have different value, but you have different price. Like so depends. So maybe my worth in market is suppose 10 lakh rupees per month. But if I'm earning 2 lakh rupees, so my price is 2 lakh, but my value is 10 lakh. So suppose the intrinsic value of the share, if I'm talking about here, so the intrinsic value of the share, so that is what. So mathematically, it is paying 4.4 rupees dividend. So the formula what we use is annual dividend divide by the cost of equity. Okay, so that is the annual dividend is 4.4 and the cost of equity is given to you is 12%. So you can write this as how much? So this is 440 by 12. So 440 by 12 means what? This is 110 by 3. So 100 by 10 by 3 means 30. Then 20, 20 means 36.67. This should be, this is the intrinsic value of the share. Clear now everyone? The intrinsic value of the share is 36.67. So it means what this means? This means that the value of the share is 36.67. So if the share in the market, if the share in the market is trading below is trading below is trading below its intrinsic value, trading below its intrinsic value, trading below its intrinsic value, then the investor should buy the share. Then the investor should investor should buy the share. Investor should buy the share. You understand the value of the share in the market is 36.67 means so because this is the value of the share in the market, and if it's trading below 36.67 you should buy this share. But you can see in this problem the share is actually trading in market for 44 rupees. So, but this share is trading in the market, but this share is trading in the market, you can see this, but this share is trading in market, but this share is trading in market, but this share is trading in market at 44 rupees. So means it is overpriced. So it means it is overpriced, it means it is overpriced. Okay, so if it trade below 36.67, you should buy it. But it's trading at 44 rupees, means it's overpriced. So because it is overpriced, so it means it is overpriced. So an investor should not buy this share. So the investor should not buy this share. So the investor should not buy this share. Clear everyone? Common sense. So the value of this share should be is the value mathematically the value of the share is 36.67. So if it trade below that, then I should buy it because in future it become 36.67. But if it trading above 36.67, then I should avoid buying this share because it is trading above its intrinsic value. Clear everyone? Anyone have any doubt? Understood everyone? Any doubt? Anyone have any doubt? Anyone, any doubt, any question you want to ask? Okay, so I hope you understood this concept. Hmm. So it's very easy. So now I talked about redeemable preference share. Now let's give you one numerical of redeemable preference share. So redeemable preference share. Let's give you a problem of redeemable preference share. Redeemable preference share. Redeemable preference share means somewhere in the future this will be bought back by the company. That is called redeemable preference share. So for example, question, write down this question that suppose an investor is considering 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 the purchase of the purchase of the purchase of 12 year purchase of 12 year 10% purchase of 12 year or 10%. Suppose investors considering the purchase of 12 year 10%, rupees 100 rupees 100 par value preference share, rupees 100 par value preference share, par value preference share. So 12 year, you understand that the life of this preference share would be 12 year. After 12 year, the company will buy back from the investor. 10% means that is the dividend rate. So 10% is the dividend rate, and 100 rupees par value means face value. So par value means face value. Face value is an important term whenever we talk about redeemable instrument. In the case of irredeemable instrument like equity share, the face value is not at all relevant word. Face value basically means that tomorrow, if a company will get bankrupt or if the company will liquidate its position, what value will they give you? That is called face value or par value. In ordinary shares also, whenever any company come up with an IPO, they always mention their face value. But as an investor, we normally don't care about face value because we believe that the company will never get bankrupt. Okay, so suppose an investor is considering a purchase of 12 year 10% 100 rupees par value preference share. Okay, the redemption value, the redemption, the redemption, the redemption value, the redemption, the redemption The redemption value of the preference share, the redemption value of preference share, the redemption value of a preference share, the redemption value of the preference share on maturity is 120 rupees. The redemption value of preference share on maturity is 120 rupees, is 120 rupees. Okay, so means when after 2 year when they will buy back the preference share, the redemption value what they will do, so they will do at 120 rupees, so they'll buy back at 120 rupees. Okay, then then the investor required rate of return, the investor required a rate of return, investor required a rate of return is suppose 10.5%, suppose 10.5%. Okay, find the value of the share, find the value of share, find the value of the preference share. This is the preference share. So this is, everyone please write down this problem, then I'll start solving this problem. So this is redeemable equity instrument. So after 12 years, the company will buy back. So the company will, the redemption value at which the company will buy back is 120 rupees. Always the whenever the instrument is issued, there is a face value given for the instrument. So why face value become the relevant word? Because dividend or interest is actually calculated on face value only. In the case of debt instrument, when we talk about interest, so there's another word what we use for the interest that we called as the coupon. So that we called as a coupon. So remember that cost of equity here is 10.5%. That cost of equity you can determine by CAPM model. You can find the value of the cost of equity. You can use CAPM model and you can find the value of cost of equity. So find the value of the share. This is the problem what we are doing. Okay. So can I start solving this problem? Guys, can I start solving this problem? Okay, so this is a redeemable preference share. So we solved two problems. Those were irredeemable preference share, but we don't know. So they may ask next time, this time in the year, they may ask you the problem based on redemption, redeemable preference share. So logic will remain the same. Okay. So so uh, so you remember the logic. Logic will remain the same. After 2 years, the company will buy back this from the investors. Okay, so if you solve this, so if you if you try to solve this, so always remember that the dividend, or so always remember that the dividend, whenever you see dividend is always calculated on dividend is always calculated on face value. Always remember that the dividend is always calculated on face value. Similarly, when I teach you debt instrument, then also there also I teach you that coupon is always calculated on face value. Dividend or coupon rate is always given in percentage. You can see the dividend is given in percentage. Your dividend is how much? Your dividend is given 12%, 10%. So 10% is the dividend. Face value is 100 rupees and your face value is the 100 rupees. What is the value of dividend? So what is your annual dividend? So your annual dividend would be 10 rupees. Your annual dividend would be 10 rupees. Okay, so what this mean? This mean that for the next 12 years, this mean that for the next 12 years, the company will give you, if you stay invested for the 12 year, it means for the next 12 year, 1, 2, 3, 4, like that you do till 12 year. It means for the next 12 year, what the company will do, company future value, what you are getting in the future value, what you are getting as a future value. So you will get dividend as the future value, that is 10 rupees. Every year the company will give you 10 rupees dividend for the next 12 year. Every year the company will give you every for next 12 year, for every year you will get 10 rupees as a dividend. And then after, at the end of 12th year, the company will buy back this preference share from you at 120 rupees. Okay, the cost of equity here is, how much is the cost of equity? 10.5%. Cost of equity is 10.5%. Cost of equity is 10.5%. For the 12 years, your cost of equity is 10.5%. Then what you can do, you can find the present value. So the present value, you can find the present value. The present value for the dividend what you receive at the end of first year would be 10 plus 10.1 by 10.5% to the power 1. That is for the first year. For second year, that would be 10 divided by 1 plus 10.5% to the year 2. Similarly, for third year, that would be 10 divided by 1 plus 10.5% for the year 3. Like this, every year you'll do for the 12 years. 12 year or how many? 12 year. For every year, like this, you'll do for the 12 year. And then you'll find the present value of your redemption share. So 10.5%. 10.5%. So 10.5% for 12 year. This also 10.5% for 12 year. Do the sum of all this, that is the price. If you do the sum of all this, you'll get the price. So you can do it manually one by one. You can do this process manually one by one. You can do this process one by one to get the price. So you can write the same thing as the price of the share. You can write the same thing, that the price of the share is equal to, the price of the share is equal to, so price of share is equal to the dividend what you're getting, 1 plus k to the power 1 plus k to the power 1 plus k to the power 2. Like whatever the dividend you are getting, you can write this till the end of the period, 1 plus k to the power n. And then whatever is your redemption value, that 1 plus k to the power n, that will give you the price of the share. So either manually you can do that work, or if you use GP, so you can derive the formula. So what is the price of the preference share? What is the price of the preference share? So you can use GP. What is the price of preference share? That is dividend divided by cost of equity into 1 plus cost of equity to the power n minus 1 divided by 1 plus cost of equity to the power n plus redemption value plus redemption value divided by 1 plus cost of equity to the power n. So this is the formula. So you can directly apply this formula for you people. For every question I'm deriving a formula, I'm giving you direct formula so that you people don't have to do struggle to get the answer for the question. So so mathematically you're weak or sound, doesn't matter. You use this formula. With the formula, you'll get the price of the preference share. This is the formula. Either you can do step-by-step calculation, or you use this formula whenever we talk about redeemable preference share. There should be a redeemable preference share whenever you have a redeemable preference share. Before that, I give you the formula of irredeemable preference share. Whenever you have redeemable preference share, you can use this formula and you get the answer. Always remember, dividend is calculated is always on face value. So the what is the price of this share? So the price dividend is 10, cost of equity is 10.5%, so 0.105. So 1 plus 1 plus 10.5%. I hope you're understanding, to the power 12 minus 1 divided by 1 plus 10.5 to the power 12 plus redemption values how much? 120 rupees. divide by 1 plus 10.5% to the power 12. I don't know you know to how to use annuity table. If you in second semester, if you are being taught how to use annuity table, then you can do it very easily. Otherwise, no problem. You can use scientific calculator, right? So you can use scientific calculator and you can find this value. So what is the price of the share? So 10. If I divide uh, if I divide 10, if I use calculator, so find what is 10 divided by 0.105. So then you get 95.2389095. So you can use this is 1.105. So 10.5, no? So 0.105 to the power 12 minus 1 divided by 1.105 to the power 12 plus 120 divided by 1.105 to the power 12. Solve this value. So in exam, they'll give you this value. In case if they'll ask you this question in exam, if scientific calculator is not given, they will give you the value. They will mention this value in the problem. In the question paper, they'll give you this value. Or you should know how to use table and UT table, whichever finance book you're referring. I don't know which book you're referring. I am Pandey, Prasanna Chandra, Brigham, or Damodran, any book you refer. At the back of the book, there's an annuity table written. You can just see the table. Otherwise, I'll tell you the value now. So 1.105 to the power 12. So that value is given to you. So it is given that 1.105 to the power 12 is 3.31396. This value is given to you. So if this value is given to you, you just need to put this value in the problem. So the price of the share is equal to 95.238095. This is 3.31396 minus 1. This is 3.31396 divided by plus 120 divided by 3.31396. Simple maths, you can solve this, everyone. So the price of the share is equal to 95.238095. This is 2.31396 divided by 3.31396 plus 120 divided by 3.31396. So now you solve this. Now you solve this 2.31396 divided by 3.31396. You got this value into 95.239238 So I'll get the price of the share. So the price of the share I'm getting is 66.4996364 plus this is how much? This is 120 divided by 3.31396. So it is 36.21045. So the price of the share is nothing but this plus 66.4996364. So you'll get the price of share as 10102.7. This is the price of the share. Okay. Anyone, any doubt? Okay. Anyone want to ask any question? Anyone, any doubt? Yogeshwari, Chaitanya, Divya, Gitanjali, Harish, Karthik, Prajwal, Prakriti, Priyanka, Ranjita, Ravi, Teja. Any doubt, anyone? Virendra, Vidya, Suraj, Sanjay. Any doubt? Simple calculation. I gave you the formula. You put the data in the formula, you will get the answer. You don't have to do any hard work. You put the data in the formula, you will get the answer. You don't have to do any hard work. So, so therefore, the only thing you have to remember the formula. If you remember the formula, put everything in this formula, you'll get the answer. This is the formula. You put everything in this formula and you'll get the answer. Clear, everyone? Same thing you would have done in Excel. So Excel, if you are done, so you have year from 1 to 12. You have year from 1 to 12. Wherever you go for placement, whichever company you go for placement, they'll ask you questions on Excel. Make sure that you are good with Excel. Otherwise, I'll take 2, 3 classes of Excel for you people so that you people develop your Excel skills. Because as a finance student, wherever you go for interview, the examiner expect you that you should know Excel, MS Excel. You should be good with MS Excel. So future value here, I ask you the future value. So the future value you are getting 10 rupees. 10 rupees. You are getting 10 rupees. So every year you are getting 10 rupees. On 12th year, you will get 10 plus 120 rupees, which is your redemption value. Your cost of equity, your cost of equity is 10.5%. Your cost of equity is 10.5%. So the present value of cash inflow. So what is the present value of your cash inflow? So if you do in the term of Excel, this is not required for those people who are weak with maths and all. Otherwise, if you can understand is well and good. So to the power 1. So you just find this. You just do this. So what should be the price of share? The price of share. The price of share if you want to find. So you do the sum. That is this. This is what I got. So either you use the formula, or you do like this. Anyway, you do like this, you'll get the same answer. This thing you could have done manually, step by step. So I would have told you, okay, fine. If imagine if I'm teaching in college, in the classroom, if I would be there, I would have written board 1 year, 2 year, 3 year, then manually would have done the calculation. Manually would have done the calculation that 10 divided by 1 plus 10.5% to the year 1, then would done 10 divided by 1.105 to the power 1. So like that for every year would have done that, and then we would have got the answer. Because we have Excel, so we are saving a lot of our time. There's another formula is there for this. So you can use EV. EV rate is 10.5%. Okay, NPR is 12. Okay, PMT means NUT, that is 10. Future value is 120, and type put 0. close bracket, enter. 1 minute. Here don't put minus sign here, put minus sign here. So the price of the share, so PV 10.5%, PV rate is 10.5%. Okay, NPR is 12 year, PMT is 10, future value is minus 130, 120. Okay, then type 0. I put minus 10. NPR is 12, then PMT is minus 10, future value 120, type 0. Okay. Leave this. So PV is equal to a rate is 10.5%, NPR is 12 year, no? PMT is minus 10, future value 0, type 0, this plus PV is equal to rate 10.5%, NPR 12, PMT 0, future value minus 120, type 0. You'll get the answer. Same thing only. So to understand doing like this way, you need lot of practice. And anyway, these things I'll teach you sometime in future. So as a finance student, you should understand all this. So you have to learn how to work on MS Excel. If you know, it will be good for you. Okay, fine. Anyone, any doubt? Any question you want to ask? Anyone, any question?